Good evening and welcome to November Risks. This is a new format, so I'm going to go over the current economic trends, key risks, and then analyze those risks, their implications, and in future videos, the ways to defend or hedge against those risks. And so the point that we're starting from is that we have high inflation and slower growth. In addition to that, we have reduced government economic support in the form of pandemic paychecks, and we also have tapering of money printing. So the central banks are reducing the amount that they're printing in order to support the economies. The key risks that we see right now are a rise in interest rates. There is already a slowdown, a very significant slowdown in China due to the real estate bubble that the government is trying to curb. And this bubble has been inflating for over 20 years. And right now it is about 2/3 in value of total assets in China. And so deflation of this real estate bubble can have serious implications for the Chinese economy as a whole, and perhaps even to other economies. We have some military tensions between Ukraine and Russia. There are some tensions regarding the Iranian nuclear program, and we have what's called Greenflation, which is basically a result of a forced transition out of fossil fuels that increases the price of energy, and we see that in the cost of oil and gas and so on. And so what are the implications of these risks? So if we look at interest rates, what increased interest rates might do is pop bubbles, both in real estate but also in what's called growth stocks. And when people talk about growth stocks, what they actually mean is stocks of companies that have profits way out in the future. And so these are companies that are more speculative. And what happens is that when the interest rates are very low, $1 of profit 20 years from now is almost equal to $1 today. But when interest rates normalize, these very far out future profits have to be discounted, and then they are equal only to a few cents today. And so when interest rates rise, all these speculative stocks would become much less valued and might crash. Similarly, in real estate, low interest rates allow people to afford basically the mortgage payments on houses that are more expensive. And even for investors, when they discount the future income from renting real estate, it makes it more profitable for them to buy and rent and lease real estate. And so those are the implications of interest rate rise. The China recession may cause a contagion, meaning that if the Chinese economy, which is already a large percentage, the second largest economy in the world, if it shrinks, then it might also affect other economies and cause a world recession. The other three, so both Ukraine military tensions, Iran military tensions, and the green inflation, are all basically, the effect of those is basically an energy shock, meaning that suddenly the portion of or the resources of the world resources that needs to be devoted to energy grows at the expense of other uses. And that often causes a recession. And so those are the risks and their implications. Now, before we move on, let me just remind you that the content of this presentation is not financial advice. It's only for entertainment and educational purposes. And please do not use this content without seeking the advice of a financial advisor. And so if we focus on the situation with inflation and interest rates, we see that we are beginning where the star is. So we have interest rate on the vertical axis and inflation on the horizontal axis. So we're beginning from a point of low interest rates with high inflation. And one of the questions that comes to mind is whether inflation can just ease by itself, meaning the arrow, the left arrow, that we can move from high inflation, low interest rate directly into low inflation, low interest rate. And there are a few reasons to doubt that this is going to be the case, because we have supply shortages that began this inflation. We have labor shortages that are pushing wages up as of now and probably into the future. And those higher wages are going to make their way into further higher prices next year. And in addition, we have the green inflation, energy shortages that are also adding to the cost of everything. And so, as far as we can see, it is going to be very difficult to reduce inflation without invoking a recession. And what might cause a recession? We saw a few reasons. We saw that higher interest rates might cause a recession, an energy shock, or just a stock crash, for example, from beginning in China or beginning in the US. It doesn't matter, but there are a few ways through which a recession can be triggered. And so, in terms of thinking about what to defend against, we can see that there are two basically probable cases or scenarios that we can think of. One is that everything continues similar to what's happening now, with high inflation, low rates, but also it means that the bubbles are extended. So the stock market bubble and the real estate bubble continue to inflate. And the second case is that those bubbles pop, then leading to lower inflation. And these bubbles can pop again based on higher rates, a China crash, a war in Iran, or a war in Ukraine that will spike energy prices even further. And so the main things that we need to think about of what to hedge against or what to defend against are, on one side, inflation, and on the other side, popping of these bubbles. And so in the next video, I'm going to address these two causes or risks and discuss ways to defend against them.